Neelotpal Sahai also joining us, Head of Equities at HSBC Global Asset Management. Neelotpal, what a morning this is. We're reeling under, the global impact of the coronavirus. News, of course, on SBI Yes Bank. Our own markets have kicked off the day with a sharp fall, even though we're just off the day's lows. I mean, it's very difficult to sort of maneuver the volatility currently. What are you advising? In your reports, how are you advising investors?
Yeah, so quite obviously because of the twin effects of the virus as well as that of the likely impact of the Yes Bank's condition with current situation is that the impact on the market might be exaggerated. But we as investors, what we do and what we like to advise is the fact that to look beyond these events, because normally what happens is that whenever some such event unfold, then there is a lot of uncertainty around these events. For both these events, for virus as well as for the Yes Bank issue, there is a lot of uncertainty how the events will unfold over the coming days and weeks, and which is why investors' reactions are exaggerated. But the thing is to look beyond that and how the things will play out, for which one has to make certain assumptions. In both the cases, we do need to make certain assumptions about how the virus issue will unfold, and probably based upon those base assumptions, as well as that of the financial conditions, financial markets in the India also, how that will unfold, and based upon that, we need to take a decision. In such a short while, one does not make changes to the portfolio, one does not advise changes to the portfolio in such a short while, because the investment is from the medium to longer term perspective. And from the medium to longer term perspective, the most important thing that we should be looking, and we are looking, is that how the profit pool is that growing, and how is the profit pool migrating across sectors and within the sectors, and which are the companies and the banks likely to gain out of it, and that's what we are focusing on.
All right, fair enough. You know, we were hearing from some different views in the morning, talking about how they're expecting the markets to get even more polarized after this, contrary to the earlier expectation that, post a sharp sell-off, we might actually see a more broader-based recovery. What's your sense?
Quite possible. I wouldn't give a general answer for the market as such, but one could look at individual sectors and possibly see, as I was just now mentioning, is that, let's take a sector, for instance, financials, is that what is going to happen to the profit pool for the sector? Is it going to migrate towards the already winners of last 3-4 years? Is it going to go to the newer players? Our sense is that it's going to remain concentrated among the top 3-4 players, and probably their share of the profit in over of the profit pool for the financials will grow, which means the big will become bigger, the strong will become stronger. And hence, so you can say that the polarization effect would be more pronounced in the sectors like that of financials. It might be true for some other sectors also where the same kind of consolidation is happening. But in some other sectors where there is overall, in general, the profit growth is going to happen, so we might see a different kind of behavior. But by and large, I agree with your assessment, is that since the tough economic situation is prevailing and the profit pool is limited and going to remain limited, so we can see a polarization of profit and hence of that the market performance.
All right, and within that, what about financials? I mean, how do you see the trend there? Do you see action to, whether it be the private names, some of the select larger NBFCs, continued route when it comes to public sector names? I'm just trying to understand the add-on implication of the current nervousness in and around the Yes Bank deal.
So we have always preferred, this is one of our preferred sectors, and within the sectors we have always preferred the sectors with more granular liability as well as granular asset side. If there is a granularity on the liability as well as on the asset side, the better it is. And in fact, the same trend that we have seen with respect to the larger banks, both among the private banks and one or two the large PSU banks as well. which is why we see that those banks has been gaining market share even though the credit growth is now close to about 8% and probably going to remain below the nominal GDP growth in the coming year as well. But some of the bigger banks and the stronger banks continue to grow much faster pace and gaining market share, and which is why our preference has been towards the larger private corporate banks, as well as one or two of the larger NBFCs which have got access to the liability, and since it has been a granular liability base, so they have been able to get liability even in the tough market condition. Going forward also, if the assumption is that the market condition, financial market condition, that is going to remain tough, so in that situation, probably we'll see more polarization, and the stronger banks and the bigger banks would be able to get liability at the cost of the weaker players in the sector. We'll continue with our existing position and continue to prefer the larger private banks as well as one or two larger NBFCs.
Okay, fair enough. In terms of really trying to understand how long or how deep this is going to go, everyone's fairly clueless. But do you feel that we're going to remain linked to also what we're seeing globally, or is there going to be a divergence there? Because the kind of sell-off we're seeing in the US markets currently, do you feel that that is also, of course, on the back of the steep valuations we were already seeing in those markets, or that it is a larger global trend on the back of the virus scare?
Yeah, so the answer to this would be at the two levels. Actually, what is likely to happen in the near term and what is likely to happen in the medium to longer term. In the near term, quite obviously, the linkage would be there with the global financial market. What was also happening in the last 6 months to a year or so, our markets has been doing well along with the global financial markets, despite the fact that the economic conditions were deteriorating and the financials of the corporates were also growing at a much lower pace than expected. But yet the capital markets, equity markets was doing well. That was on the back of the FII inflows as well as the domestic inflows. But FII inflows was a very strong reason for this markets to do well. Now, if there is a concern in the global financial market, and if there is a risk of trade and there is an FIA outflow instead of an inflow, so that could very well impact the Indian equity market, at least in the medium term, but in the short term. But what will happen in the medium to longer term is that one does need to reassess the economic situation after the virus outbreak has peaked, and one is able to assess the economic damage the virus has done, and that will probably happen over the medium term. But over the longer term, what can also possibly happen is that a number of countries and the corporates will like to have a relook at the global supply chain, which is right now China-centric, and the dependence upon that, because now one knows that there is also a cost to be too much of dependence on only one supply chain. In the past, all these corporates have benefited from that, but now this year there is a risk associated with being too dependent on one supply chain. So if one were to have a diversification of the supply chain and probably have a China plus kind of a strategy, then one also might look as India as one of the alternatives. Given also the fact that in the last few months, India's corporate tax rates has been brought in line with the Southeast Asian economies, as well as the nominal rates also has been coming down over the last year or so. At the same time, the ease of doing business ranking has also improved over the last 5 years. That means that probably investment setup in India is likely to improve and that situation, but that is for the medium to longer term, which is why I said that in the near term there would be a linkage with the global financial market and there would be a downside, but in the medium to longer term, India could probably benefit from this crisis that we are facing.
All right, let's take a very quick break on that note. Thanks so much for joining us this morning, Neelotpal, and taking us through your perspective.